All right, we got our friend Jackson Shembekar back in studio. Welcome back, sir.
Thank you for having me, Brandon.
My pleasure. Good to see you. Jackson wrote the book as well, The Crypto Kid. I'm holding it up to the camera if you're watching our TV show version of the program on Apple TV, Amazon Fire TV, Roku, maybe YouTube or Facebook. You can see his book there as well as online. But I wanted to ask you, there's a lot of stuff going on in the crypto world, man.
Absolutely.
It seems kind of interesting. So we were kind of talking a little previous, what's the catalyst when you're looking, trying to indicate or trying to figure out, hey, where's this going? Crypto going up or down today or this week? What are some of the key indicators?
For sure. I kind of approach that question from a macro standpoint. You have to think about all the big companies involved in cryptocurrency. Mm-hmm. What are they doing and why are they doing it? So you think about some of these big bulls like MicroStrategy and Tesla and these big companies, Square, that are purchasing Bitcoin in large quantities. These guys' views are not really going to change. So then you have to take a step back and say, well, what are the retail investors doing? And one of the big indicators I use, actually, and it's a very simple one, it's not an actual fundamental indicator, it's when are more and more people my age, older than me, people that are not in crypto, when are they approaching me and asking me questions? Because typically, when they're approaching me and asking me questions, the price is high, the price is trending. Yeah. That's typically your time to sell. And when nobody's calling me, when nobody's asking me, when the only people that are calling me are about worrying, that's typically the time to buy, right? Because those are the overall trends there.
That's right.
So I think that's a great perspective on how to really analyze the market to see where is the energy really going, right?
Yeah.
So people talk about RSI all the time. It's called Relative Strength Index. And you can look at that on different time frames, 5 minutes, 15 minutes, an hour a day. And then there's big macro investors that look at it on the day, 7-day, and full month chart, right? And a big gauge, I think, is just the amount of interest in the supply, right? Because it's all based on supply and demand. And so that's why people often look at Google Trends. How many people want to learn about a given topic at a given time? So I think it's a great way to approach it to see where is the hype, per se, really at. Is it about Bitcoin right now? Is it about the altcoins? Is it about different networks? And why, right? Why is that there?
Mm-hmm. Yeah, that makes a lot of sense. Where's the attention going? Where's the focus going? Where the focus goes, the energy flows. So you mentioned RSI.
Yes.
What is that again?
Relative Strength Index.
Relative Strength Index.
Yes, it's one of the big key trading indicators that a lot of different traders use. So when you're trading, typically, if you're doing technical analysis, you will use a whole slew of different indicators. Mm-hmm. Now, I warn people in technical analysis all the time because over 90% of traders lose money. For the most part, unless you're going to be doing this full time, and when I mean full time, I mean that means a full trading day on top of getting up at 5, 6, 7 a.m. and putting in your research, reading the Financial Times, reading the Wall Street Journal, reading Cointelegraph if you're in crypto. You have to be on it, right? Think about all the big hedge fund managers that are wildly successful, right? Take away the fact that they have enormous capitals where they get to almost control the market, right? And you take away the morality of that, what are they doing? They're putting in 10 times the effort of your normal retail investor. And I think that's a big key point in that you not only are you using RSI, you're using every indicator in there, right? They're looking at Bollinger Bands and saying, where is the volatility? Why is it closing down now and why is it opening at different points?
Right.
And when you're actually able to know that and utilize all the different indicators, that's where that real strength in trading is going to come in.
Yeah, it makes a lot of sense. We're talking with Jackson Shembekar here on the Consumer Quarterback Show. I'm your host, Brandon Rhymes. He's a crypto expert, wrote the book called The Crypto Kid. And we had mentioned earlier the Satoshi milkshake experiment. Tell me about that.
You got it, yeah. The Satoshi milkshake experiment, I think it was a very, very interesting experiment, happened just recently. And what happened is basically this guy that knows a decent amount about crypto was hired to come in and talk to a class of kids about cryptocurrency. What is it? Why is it important? Just your basic kind of teach-in lesson, right? And it was very interesting, I thought, because in this new age, I mean, this thing is just 12 years old. It's a new technology that most adults don't even understand, and they were teaching it to kids. I thought that was fascinating.
Where was this at?
It was in America, but I couldn't tell you the state. Okay. But I think he did very, very well with it. And so what happened was, and these are 6-year-old kids. This is a first grade class.
6-year-old.
Yeah, 6-year-old. This is not high school, literally. Okay. So he's coming in, he's telling these kids about Bitcoin, kind of gauging the classroom on who knows what, right? So most of the kids have never heard of it. Some of them have. And out of the whole class, one kid actually knew that there was a 21 million hard cap. Wow. So you could extrapolate, maybe his parents are into it a little bit. He's heard the talk in the home, right?
That's funny.
But I thought it was very cool. And what the instructor did was ran a little experiment. He gave every single kid a little Bitcoin card with $6 worth of Bitcoin on it. And there's more to this. And the reason that's important is because people are often like, well, wait, Bitcoin card, right? $6 on the card. How does that work? You need a wallet with signatures. How does that work? And the reason that works is because it was on the Lightning Network, which I thought was, again, very interesting. He's utilizing the Lightning Network. Okay. And the Lightning Network on the Bitcoin blockchain is an off-chain network. It's used for efficient, fast, and low-fee transactions.
Okay.
And I think that's also very cool because it defeats the Bitcoin scalability issue. And that's a big issue that people have been talking about, that as more and more transactions build up, how is we, a society, how are we going to adopt that on a large scale? And it proposes a very big question, right? Visa handles hundreds of millions of transactions every day, right? How does Bitcoin compete with that? Because we can't handle hundreds of million transactions a day. But what we can do is when you're at Chipotle and you order your $9 bowl, right? You can use the Lightning Network to pay for it. Rather than waiting for something that takes 6 confirmations on the Bitcoin blockchain, high fees, right? It's rather inefficient. And I've said this all the time, that while I do think Bitcoin as a technology is very proprietary and it has a lot of use cases, it is obsolete, no doubt. It really is obsolete. And so what this network does is it transforms that obsolescence into something that can actually be utilized today. Now, it's still very small, though. I must stress that because it's used for small transactions, only roughly 4,000 Bitcoin are operating on the Bitcoin Lightning Network. So that's another interesting thing. But back to the experiment, what he found was that these kids, it's a class of just 27 kids, and 5 kids spent their Bitcoin on milkshakes, right? They spent their $6 on the milkshake, and the other 22 held it.
Okay.
And that was a big concept because it's the HODL theory, right? Hold on for dear life. Let's just hold it. And let's say, hopefully, that this $6, right now we're in a bear market, hopefully the $6 is $12 later, right? But that was very fascinating because you compare that to the Stanford marshmallow experiment. And let's go back a little bit. Out in California, this was years and years and years ago, very, very popular experiment. I think it went viral at the time. What they did was a researcher came in the room, and again, same sample size, same type of people. He gave marshmallows to 5-year-olds and said, this is what we want to do. Here's a marshmallow. I'm going to leave the room for a bit, and when I get back, you're going to get a second marshmallow. But if you didn't eat the marshmallow. Got it. But if you eat the marshmallow, then you can't get a second marshmallow. So the whole test is delayed gratification, right? And the majority of the kids ate the marshmallow, right? And there was different subset of kids where there's some group of kids where the second the researcher leaves, they eat the marshmallow right away. Then you have some where they really tried to resist the urge, but then 5 minutes later they gave in. And then you have the third group where they completed the task. 15 minutes later, they get 2 marshmallows, and they ate both the marshmallows. And they tracked those kids' learning behavior over more than 20 years, which was very interesting.
20 years.
And they found that one of the, I think it was actually 40 years, but I'm gonna stay safe with the over 20.
Okay.
And what they found was that delayed gratification was one of the top indicators for future success in the business world. I found that very interesting. And going back to the Lightning experiment now with the milkshakes, it showed how these kids viewed it as delayed gratification. Because all of the kids wanted a milkshake, right? But some kids said that, hold on, I'm just going to listen and hold on to this card and hope that I can get 2 milkshakes in 6 months, 3 months, 1 month, whenever that time frame is. And that time is very interesting because there's so many kids, they just want their milkshakes, right? But they were able to hold on to that and utilize the network and hopefully have that mindset of something can grow in technology.
Wow. Yeah, that reminds me also that the marshmallow experiment with the 5-year-old kids, the 20-year study, it reminds me of another study that I heard about in a book. It was Dr. Edward Banfield from Harvard. He conducted a 40 or 50-year study, and he wanted to know what was the key indicator for people being successful versus some that don't. And after this long-term study, he found that the number one key indicator for people that were more successful, moved up that socioeconomic ladder, was long time perspective.
Absolutely.
So very similar. It's funny, so the more that we look into the future and then kind of future pace and then come back and say, okay, what do I need to do to hit this mark? Now I'm going to hit that mark, my 10-year goal, my 5-year goal.
No doubt, for sure.
It's cool. That's interesting. I mean,
I completely agree. I think you can tell a lot about a person financially, right? Based on the time frame that they look at their investments. And investments or lack thereof, right? If they're thinking how much money am I going to make today versus in the week, right? You can kind of see where they're at. If they're focused on just today, probably not doing that well. If they're focused on weekly, maybe they have a job, they collect their paycheck at the end of the week, okay, that's fine. Is it semi-weekly? Is it once a month? Okay. Is it once a year, right? And so I think that if you really, really expand that thought process, the people that really care about their earnings on the yearly, 5-year, 10-year, that's what ends up being more important.
Yeah, and even Tony Robbins, one of my favorites, says that human beings overestimate what they can accomplish in a year. When December 30th rolls around and we start setting those New Year's resolutions, and we significantly underestimate what we can do in 5 years.
I agree, for sure.
The psychology of a human being, right?
Yes.
It is. It's interesting. And then I was just thinking about the chapter in your book, too. We were talking about when it says, so the qualities you need to become a good investor. Number 1, patience. 2, competency. 3, instincts. And then number 4, ignore the short term.
Yes, for
kind
sure.
of goes hand in hand with that.
Absolutely. Yeah, ignore the short term really comes in there. And then I'm going to tie it in a little bit with everything there. that when you are competent, when you're a competent investor, that acknowledges that you're doing the research and you're putting in the time for an investment decision. You're analyzing this company, this business, this product, and saying that I am going to invest in it because I believe that it is undervalued today. That's all an investment is, right? You're saying that this company is worth X, and I believe that at the moment it's less than X.
Yeah.
That's it. And so if you can ignore the short term on that and say that as long as nothing is fundamentally changed about your investment decision, that means that you're going to be correct in the long term. But you have to have perspective and say that unless something changes about your investment decision, if the CEO steps down and a new, worse leadership comes in, if something about the coin changes, if something about anything changes, then that's fine and you can reevaluate. Anything like that, yes. But if it does not, and you are competent, right? Because you have that's a big assumption, right? If you're not a competent investor and you don't do sound research, then everything goes out the window.
Yeah.
But with that first assumption, kind of an if-then statement, if you are competent, you can do that, and you're confident in your abilities, then I think it unlocks any door where you should stick with your decision and say that X will happen because of Y, Z, right? There's always a back end on that because the long term is going to come in. It's just, can you get there sooner or later? Yeah. That's the only question.
Makes a lot of sense. All right, coming right back. We're going to take a quick break. When we come back, more with Jackson Shembekar here in studio. Jackson Shembekar is in the house. He's the author of The Crypto Kid, and we're going to talk about some of the stuff you got going on. You got some NFL connections now with NFL and some of your crypto.
For sure, yeah. What we've done is we've had a slew of people from the NFL and the Alumni Association there. So you have real guys that have won Super Bowls and they're retired and they've done extremely, extremely well. And they kind of want to get into this new industry. And they have extensive amounts of data, extensive amounts of interesting data where you get to use that and kind of license it and kind of market it, right? Because these are players where now that they're out of the league, they're still very well connected to the league. They just don't play on the field, right? And so we've reached out to some friends, and I met Najee Good, a connection in New York City a couple months ago, and we finally came to an agreement where during the NFL Hall of Fame Alumni Association week, what we're going to do is on that, the new inductees are going to come in, and we're going to have a 50-50 rev share split where he is going to license one of my NFTs and use the NFT for merchandise and for marketing. And it's very cool because the NFT is the #1 blue chip project. It's the Bored Ape Yacht Club. I've talked about it on here before.
Yeah.
And so one of my monkeys that is aesthetically pleasing subjectively, right? They're going to throw the NFL Alumni Association logo on the ape, and then they're going to also have many other spin-offs. So what they're going to have is a player that is loaded up with tattoos. We're going to put tattoos on the monkey, right? And then we'll license it as his version of the ape. A player that wears funky glasses, we're going to put the funky glasses on the ape. So we're going to do whatever change we need to make it personal, and then we're going to market it such that we can have different products to go with that.
Okay.
Right? And that's going to be the first step that we're doing. So we're going to put those on footballs and sell the footballs. We're going to put them on t-shirts and sell the t-shirts, right? That's just phase 1. Then phase 2 is we're going to have a derivative project, something off-chain from the Bored Ape Yacht Club, but something that will be, I think, pretty cool because what we'll be able to do is we'll be able to add things to those personal NFTs. So we'll change the NFT and then say, if you buy this NFT, if you mint the NFT that is, then you get 2 Super Bowl tickets. Then you get access to 5 games. Then you get whatever else you want. What you get, maybe a signed Bucks jersey by Tom Brady, if that's the NFT, right? So there's a bunch of different ways we can do this. And we finally have it done where I can give them exclusive access to the product. The product should hopefully drive sales, being that it's such a popular product. And it brings attention to both me and the NFL Alumni Association.
Yeah.
And ideally, it'll be lucrative on both sides, and that's the deal that we've kind of come to and how we structured it.
Yeah, and each one of those different, for the Bored Ape example, each one of those different styles and looks is in essence, the NFT, trying to relate it for the audience, is a work of art. It's a one-of-a-kind, unique work of art.
And I think that's the one of the coolest things because it goes back to what an NFT is. It's still a digital collectible.
Yeah.
And so the NFT will be able to be held in someone's wallet forever. And there still will be a resale value associated with that. So I think it's very cool because people get to participate in that, and we as creators get royalties on the back end as well. So it's a win-win for everyone. And if you don't want to participate, you don't have to. It's still just consumerism, which I think is very cool.
I like it. And then, so we talked about licensing NFTs.
Yes.
And then risk of staking.
Yeah. So to jump into staking, it's been a big topic for a while, right? And so what staking is it's just the mechanism behind proof of stake. And so the big 2 mechanisms that people talk about in cryptocurrency are proof of work and proof of stake. So proof of work is how miners bring new, let's use Bitcoin as the example, new Bitcoin into the ecosystem, right? And the hard cap is 21 million. We're just over 19 million at the moment. So we've got less than 2 million left of new Bitcoin that will come in the ecosystem over the next 100 plus years. The last Bitcoin to be mined will be in 2140. So that proof of work mechanism, while it's very very useful, and it's not necessarily efficient. It wastes a lot of computational power. Now, I would still be on the argument side where the computational power is benefiting society as a large, and that even though we're expending it, it's done for a good use. But the other argument is that we should switch to proof of stake, which is far more efficient. And the reason is because it's done by validators who lock up their Ethereum and then validate transactions on the blockchain. And the idea is that if you go against it, you simply lose your escrow. And the whole thing in cryptocurrency is that everything has to be financially incentivized, because if it's not,
Right.
the integrity of the network will be compromised,
Right.
no matter what, right? Who doesn't want to make money, right?
Yeah.
And
Why
so
would you do it if not?
Exactly. And so miners are incentivized by spending their power, which they have to pay for in electricity, for new minted Bitcoin, right?
Right.
And that's the trade-off there. The trade-off here is that you get to stake and you get rewards on top of those staking pools, which is very, very big, right? So what has happened is that a lot of people stake their Ethereum, right? And now there is a minimum staking requirement. So we're talking about significant amount of Ethereum here. And we're talking about retail investors as well. People that bought the GPUs, they set it up, they're tech-savvy people. And what has happened in this crash is that a lot of people found that they were over-leveraged. It's a common theme in crypto because the volatility is so big. People always say don't invest what you're not willing to lose, but a lot of people still do it anyway, right? And what we've found is that in the last 6 months, stakers have lost 36%, 35.6% more than ordinary Ethereum investors, which is an enormous amount, right? It's just been absolutely brutal to the staking community.
Wow.
But the issue is that you can't liquidate positions, and not that I would advise to do that anyway at this point, because right now I think it's a big buying opportunity.
Right.
But the big problem is that the Ethereum is locked up. And so
Okay.
people have done this over the long term, right? Because the idea is stake it, build rewards on it, and we can choose to unlock 4, 5, 6, 7, 8, 9, 10 years down the road, right?
Okay.
But what's happened is that in the short term now, this crash is unanticipated by a lot of people, at least the severity of it, right? Where Ethereum's 2K and below, where we were at 5K less than a year ago, right?
Right.
That severity is just not
So
something
over
that
50%.
Yes,
down.
for sure. Way more than 50%. It's become a rewind of what happened in 2018. And
Okay.
2018 was 80%, right?
Wow.
And so we're approaching those numbers where this is just the repeat, right? This is the crash of 2022. It's going to last probably through, I would say, through 2023. However, I do think we'll have a recovery in Q3 and Q4. But it's not, we're at least what we're looking like, right? For if historical sector rotation patterns repeat, it's looking like a strong bull recovery won't happen until 2024, 2025. And that goes along with the halving date in 2024 and the subsequent 6 to 18 months afterwards.
We got to start wrapping here, but tell us how people can get in touch with you, your websites, your Instagram.
For sure, yeah. The website is thecryptokid.com, and you can always reach out to me personally on Instagram. I read all the DMs. It's Jackson Shembekar, last name Shembekar.
Jackson Shembekar, the Crypto Kid.
You got it, Brandon.
The Crypto Kid. Hey, good stuff, man. That's a really cool analysis. You know, honestly, I probably picked up about 80% of that.
Yeah, no worries.
but yeah. So hey, you got to reach out to Jackson if you're interested in crypto. A lot of good stuff to learn. It's an emerging market, or it's a market that you should learn more about.